Trading is one of those pursuits that seems straightforward until you actually try it. You see the charts, you understand the concept of buying low and selling high, and you think to yourself, how hard can this really be? But then you start trading with real money, and suddenly everything changes. The charts that looked so clear in hindsight become foggy and uncertain in real time. The confidence you had while paper trading evaporates the moment your actual capital is on the line. Here's something most traders don't want to hear, something that goes against every instinct we have as humans who are wired to take action and make things happen. The best trade you can make today might be the one you don't take at all. I know that sounds counterintuitive. After all, you can't make money if you're not in the market, right? But this isn't about sitting on the sidelines forever. It's about understanding that discretion, patience, and the ability to say no are just as important as knowing when to say yes. Think about the last time you took a trade that you knew deep down wasn't quite right. Maybe the setup wasn't perfect. Maybe you were bored and needed some action. Maybe you were trying to make back losses from earlier in the day. Whatever the reason, you convinced yourself it was okay to bend your rules just this once. And what happened? Chances are, that trade didn't work out the way you hoped. This happens to everyone, from complete beginners to people who've been trading for decades. The difference between consistently profitable traders and everyone else isn't just about technical analysis or having some secret indicator. It's about understanding that trading is fundamentally a game of probabilities and that every trade you take should have a genuine edge. When you take trades that don't meet your criteria, you're not just risking the money on that particular trade. You're training yourself to ignore your own rules, and that's a habit that compounds in the worst possible way. Let me tell you about a trader I know who learned this lesson the hard way. He was actually pretty good at analysis. He could read charts, understand market structure, and identify high-probability setups. But he had one major problem. He couldn't stand being out of the market. If he wasn't in a trade, he felt like he was missing out on potential profits. So he would take marginal setups, trades that kind of looked right, but didn't quite meet all his criteria. Over the course of a year, he calculated that these marginal trades, the ones he took out of impatience or boredom, accounted for nearly 80% of his losses. The trades that met his strict criteria were actually profitable. He was literally losing money by trading too much. This is more common than you might think. In fact, overtrading is probably the single biggest destroyer of trading accounts. And it's not always obvious that you're doing it. You can convince yourself that you're just being active and engaged with the market. You can tell yourself that you're taking advantage of opportunities. But if you're honest with yourself, a lot of those trades are really just you trying to create excitement or make something happen because sitting and waiting feels uncomfortable. The market doesn't care about your need for action. It doesn't care that you've been staring at screens for 4 hours and feel like you should have something to show for it. The market does what it does, and your job as a trader is to identify the moments when the odds are genuinely in your favor and to have the discipline to wait for those moments. Here's another way to think about it. Every trader has a finite amount of what you might call trading capital, and I don't just mean money. I mean mental capital, emotional capital, and attention. Every trade you take draws on these resources. When you take a bad trade or a marginal trade, you're not just risking money. You're using up attention and emotional energy that could have been saved for a better opportunity. You're creating stress and potentially putting yourself in a negative emotional state that will affect your decision-making on the next trade. Professional traders understand this instinctively. They know that preservation of capital, both financial and psychological, is the foundation of long-term success. That's why they can sit and watch the market for hours without taking a single trade if the right conditions aren't present. They're not being lazy or unambitious. They're being smart. They understand that the market will always be there tomorrow and next week and next month, and that there's no prize for trading the most. Now, I'm not suggesting you should never take trades or that you should become so cautious that you're paralyzed by indecision. That's the opposite extreme and equally problematic. What I'm talking about is developing the skill of discernment, of knowing the difference between a genuine setup that meets your criteria and something that just sort of looks like it might work. This skill doesn't come naturally to most people. We're hardwired to see patterns everywhere, even when they don't exist. We're also influenced by a whole host of cognitive biases that push us toward action. There's the fear of missing out, which makes us jump into trades because we're worried the market will run away without us. There's recency bias, which causes us to put too much weight on whatever just happened. There's revenge trading, where we try to get back at the market for taking our money, as if the market were a sentient being that cares about our personal grievances. All of these psychological factors work against the kind of patient, disciplined approach that successful trading requires. And the only way to overcome them is to build strong habits and to have a set of rules that you follow no matter what your emotions are telling you in the moment. Let's talk about what this actually looks like in practice. Say you trade a particular strategy based on specific technical setups. You know from your backtesting and experience that when all your criteria are met, you have a 60% win rate with a favorable risk-reward ratio. That's your edge. That's what makes you profitable over time. But what happens when you start taking trades that only meet some of your criteria? Maybe they meet 3 out of 5 conditions. You might think that's close enough, but the reality is that you've now entered territory where you don't actually know what your edge is. You're essentially gambling rather than trading based on a proven statistical advantage. The best trade you haven't taken yet is the one that would have violated your rules. It's the trade that looked tempting but didn't quite fit your system. It's the trade you wanted to take because you were bored or frustrated or trying to make back losses. Every time you resist the urge to take one of these trades, you're actually making a profitable decision, even though it doesn't feel like it at the time. You're keeping your capital intact for the next real opportunity, and you're reinforcing the discipline that separates professionals from amateurs. There's also something to be said for the concept of opportunity cost in trading. Every dollar you lose on a bad trade is a dollar you can't use on a good trade. Every moment you're stuck managing a position that shouldn't have been taken is a moment you're not available for a better setup. This is especially true for traders who have rules about maximum position size or maximum number of concurrent trades. If you filled up your slots with mediocre positions, you literally cannot take advantage of the excellent opportunity that presents itself an hour later. Some of the most successful traders in history have talked about this principle. They've said things like, "I wait for the market to throw me a pitch right down the middle, and I don't swing at anything else." They understand that patience isn't passive. It's an active skill that requires constant attention and discipline. They're watching the market, analyzing conditions, and preparing for the right moment, but they're not pulling the trigger until everything aligns. This approach requires a fundamental shift in how you think about success in trading. If you measure your success by how many trades you take or how busy you are, you're measuring the wrong things. The real measures of success are things like consistency, adherence to your plan, and long-term profitability. A trader who takes 5 trades in a month and makes money on 4 of them is far more successful than a trader who takes 50 trades and breaks even or loses money, even though the second trader might feel like they're working harder. It's also worth considering that the feeling of missing out on a trade is often far worse than the actual reality of missing it. How many times have you watched a setup develop, decided not to take it for whatever reason, and then watched it work perfectly without you? It stings, right? But here's the thing. If you tracked all the trades you didn't take over a period of months, you'd probably find that plenty of them didn't work out. The ones that did work stick in your memory because of the emotional impact, but you're not seeing the complete picture. You're experiencing a form of selective memory that makes it seem like you're missing out on more than you actually are. One practical exercise that can help with this is to keep a journal not just of the trades you take, but of the trades you almost took. Write down why you were tempted, what stopped you, and then follow the trade in your charts to see what would have happened. Over time, you'll start to see patterns. You'll notice that your instinct to hold back often saved you from losses. This concrete evidence can help reinforce the behavior and make it easier to be patient in the future. Another aspect of this that doesn't get discussed enough is the impact of trading frequency on your learning and development. When you're taking lots of trades, you're generating lots of data, but you're also generating a lot of noise. It becomes harder to identify what's actually working and what isn't because there's so much to analyze. When you're more selective and only take your highest conviction setups, each trade becomes more meaningful. You can study it more carefully, understand what worked and what didn't, and continuously refine your approach. There's also something to be said for the psychological benefit of having a higher win rate. Now, I'm not saying you should chase win rate at the expense of risk-reward ratio. That's a different discussion entirely. But there is a psychological advantage to seeing that when you do pull the trigger, you tend to be right. It builds confidence in your system and in your ability to execute. When you're taking every marginal setup that comes along, you're probably going to have a lower win rate, And that can create a negative feedback loop where you start doubting your system and making even worse decisions. Let's address a common concern. Some people worry that being too selective will mean they don't get enough trades to make the kind of money they want to make. If you're only taking a few high-quality trades per month, how can you build wealth? This concern usually comes from a misunderstanding of how professional trading actually works. The goal isn't to trade frequently. The goal is to be profitable. A trader who makes 5% per month on their account with 5 trades is doing much better than a trader who makes 2% per month with 50 trades. The first trader is more efficient, taking less risk, experiencing less stress, and probably enjoying the process more. If you absolutely need more trading opportunities to reach your financial goals with your current account size, the answer isn't to lower your standards and take more marginal setups. The answer is to either find additional strategies that have different criteria, so you're increasing your genuine opportunities, or to focus on growing your account to a size where fewer high-quality trades can produce the returns you need. There's also the reality that market conditions change. There are times when opportunities are abundant and times when they're scarce. A good trader adapts to these conditions rather than trying to force trades when they're not there. During choppy or unclear market conditions, the best traders often reduce their activity significantly. They know that these periods are more likely to generate losses, so they preserve their capital and wait for clarity to return. Less experienced traders often do the opposite, increasing their trading frequency and frustration as they try to make something happen, which usually leads to accelerated losses. Understanding market context is crucial here. Not all trading days are created equal. There are days when volatility and conditions align perfectly with your strategy, and there are days when they don't. Being able to recognize the difference and adjust your participation accordingly is a huge edge. Some days, the best decision is to watch and learn without risking capital. These days still have value because you're building pattern recognition and understanding without the emotional interference of having money on the line. Here's something else to consider. The emotional state you bring to each trade matters tremendously. If you're trading because you're bored, anxious, or trying to prove something, you're already starting from a compromised position. The trades you take should come from a calm, analytical place where you've identified an opportunity that fits your criteria and you're executing your plan. The times when you feel the strongest urge to trade are often the times when you should be most cautious. That feeling of urgency is usually your emotions trying to hijack your rational decision-making process. Professional traders often talk about being comfortable with inaction. They've learned to find satisfaction in the process rather than just the outcomes. They enjoy analyzing markets, refining their strategies, and waiting patiently for the right moments. Trading becomes less about constant action and more about mastery of the craft. This is a fundamental mindset shift that takes time to develop, but it's essential for long-term success. The concept of the best trade being the one you haven't taken yet is really about recognizing that trading is a marathon, not a sprint. It's about understanding that your edge comes from consistency and discipline over time, not from trying to hit home runs on every at-bat. It's about respecting the market and respecting your own plan enough to wait for the right conditions before committing capital. This doesn't mean you should become so risk-averse that you never trade. Fear and greed are both dangerous emotions in trading, and being paralyzed by fear of losses is just as problematic as being driven by greed for gains. What I'm describing is a balanced approach where you're actively engaged with the market, constantly learning and analyzing, but only executing when your criteria are met. You're present and ready, but patient and disciplined. One way to think about this is to imagine yourself as a hunter rather than a farmer. A farmer plants seeds and tends crops every day, working constantly. A hunter prepares carefully, waits patiently for the right opportunity, and then acts decisively when that opportunity presents itself. Trading is much more like hunting. The preparation happens constantly, but the actual execution happens in brief moments when conditions are right. The successful hunter doesn't shoot at every animal that moves. They wait for the right shot, the one they've prepared for, the one they know they can make. Your trading account is your ammunition. Every bullet counts, and you can't afford to waste shots on low-probability targets. When you take trades that don't meet your criteria, you're essentially firing into the woods hoping to hit something. When you wait for your high-probability setups, you're taking careful aim at a target you've studied and prepared for. Which approach do you think leads to more consistent success? The bottom line is this. The market will always give you more opportunities. There will always be another trade. But your capital, your emotional energy, and your psychological resilience are limited resources that need to be protected. Every time you resist taking a trade that doesn't meet your criteria, you're making a deposit in your account of discipline and self-control. These deposits compound over time, just like financial returns, and they become the foundation of long-term trading success. The best trade you haven't taken yet might not feel like a victory in the moment, but it's often the decision that keeps you in the game long enough to experience the victories that matter.